Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. We continue our topic about inventories. In the last meeting, I've explained about why do we need a control of inventories. It's almost a similar idea to the cash because you want to save it or protect it against the damage and theft. You want to provide accurate information as well on the financial statement. Yeah, so certain security measures are taken to protect the inventory. Okay, we discussed that, especially for merchandising business, when they purchase the inventories, the merchandise inventories, normally it has different costs. Yeah, because they buy it in different times. Yeah? Because of the different costs in the merchandise inventories that we purchase at different dates, then we need to have an inventory cost flow assumptions to record at which cost that we assign to certain sales amount. Yeah? Because if purchase at the beginning of the month, it has a different purchase price. We purchase at the middle of the month, it would have a different purchase price. So which price that we take as our cost of merchandise sold. So that's why the companies has to use certain inventory cost flow assumption. Yeah? I explained to you about the 4 inventory cost flow assumptions, FIFO, and then weighted average, and then LIFO, and then specific identification unit. But in here, we focus on 2 inventory cost flow assumptions, which are first in, first out of FIFO and weighted average cost. Yeah? So under first in, first out, or FIFO, the focus is, the assumption is that whatever the first units that we purchase, it will be assumed to be the first one to be sold. Yeah. So by saying that, then we also assume that the ending inventory will consist of the most recent purchases. Because the earliest purchases, we assume it to be already sold. Yeah? Meanwhile, the weighted average, we will calculate the weighted average cost for the units sold as well as for the ending inventory. Yeah? So we illustrated the example by using FIFO, or weighted average cost, or other inventory cost flow assumption. It will affect differently on the amount of cost of merchandise sold, as well as the gross profit, and the amount of ending inventory that we disclose it in the statement of financial position. Okay, we've also covered about how do we do the inventory cost flow method under perpetual inventory system. So we have to tabulate it to see the flow of the record of purchases as well as the cost of goods sold. So we follow the subsequent dates of transaction. If there is a purchase, then we record the purchase in the column of purchase. If there is a sales, then we record it in the column of sales. Until we go to the end of the month, we get the balance for each cost of merchandise sold, as well as the ending inventory for the month. And remember, under perpetual inventory system, every time there is a transaction related to the inventory, then we will record it. Either the purchase of inventory or the sale of inventory. Because perpetual inventory system means we always update the inventory account. Yeah? Okay, under weighted average cost method, Every time we make a purchase under perpetual inventory system, we will calculate the new weighted average unit cost. Yeah? And if there is a subsequent sale after the purchase, then we'll use that the last weighted average unit cost to calculate the cost of merchandise sold. So this technique is called as a moving average. So the weighted average cost will be different from time to time whenever there is a new purchase. Yeah? So if you notice here, January 1st is the ending inventory from the previous month. And then on January 4th, there is a sale of 700. Then we'll use the previous unit cost. We don't need to calculate the weighted average cost every time there is a sale. But whenever there is a new purchase, let's say in this example, a new purchase of 500 units with a unit cost of 22.4. So the ending balance of the inventory has to calculate the new weighted average unit cost. So we take the total previous inventory balance, 6,000, plus from the new purchase, 11,200. We add it. And then we divide with the total number of units, which are 300 plus 500. Yeah? That's how we get the new unit cost of 21.5. Yeah? If there is a new sale, then we just use that last weighted average unit cost of 21.50. Yeah? Until we have a new purchases again. Then if there is a new purchases again, we calculate again the new weighted average unit cost by taking the last balance plus the new purchases made. Yeah? So that's how we get the cost of merchandise sold under weighted average unit cost as well as the ending inventory. Remember, the ending inventory is not the total of the whole thing in this column. We just take the last record of the inventory as our ending balance. Yeah? Okay, under periodic inventory system, remember we don't maintain a merchandise inventory account. Yeah? And every time there is a sale under periodic inventory system, we just record the sales. Yeah? Either we debit the cash or account receivable and we credit sales revenue. We don't record any cost of merchandise, so debit and credit to merchandise inventory like we did for perpetual inventory system. Yeah? So how do we identify the balance of inventory under periodic inventory system? We will do the physical count of the inventory at the end of the period to identify the ending balance of the inventory. Yeah? Once we know the cost of the ending inventory, then we can calculate the cost of merchandise sold. We take the same illustration to see how we calculate the ending inventory under FIFO method, but for periodic inventory system, the same example as previously for perpetual system. So this is the transaction, beginning inventory, and there are purchases after that. So, and the physical count at the end of the month, it shows that there are 800 units on hand. Yeah? So how do we determine the cost of ending inventory for that 800 units? Under FIFO, as we have assumed that the ending of inventory for FIFO will consist of the last stocks that we have, or the last stock that we purchase. Yeah? So how do we identify that? We'll take from the last purchase that the company made. In this example, the last purchase was made on January 30th, yeah? 600 units at 23,300. Yeah? And the last purchase only has 600 units. Meanwhile, from the physical count, we identify that there are 800 units of ending inventory. So we need another 200 units to make it 800. So we move a little bit to the most recent purchase before January 30th, yeah? Which is the January 10 purchase, yeah? 200 units. We take it 200 units, yeah? Even though on January 10, the company purchased 500, but we just take 200 units to make it as the ending inventory because we want to make it total as 800 units. Yeah? So we get the cost of ending inventory as 18,460,000. So by identifying the ending inventory, we can calculate the cost of merchandise sold. We take the beginning inventory plus purchases, then we get the total cost of merchandise available for sale, and then we minus the ending inventory, then we get the cost of merchandise sold. Yeah? Because opening inventory plus the purchases, it will give us the total amount of merchandise inventories that we have for us to make the sales. Yeah? And we deduct the ending inventory, whatever left in our company. So that difference will show us how much the amount of inventory that has been sold. That's the logic of the calculation. Just to show the flow of costs under FIFO. Beginning inventory or purchases in this first row, and then it will be sold later on, then we get the cost of merchandise sold. And then January 10, there's a purchase of 500 units, yeah, and the merchandise available for sale equal to 11,200,000. So 300 units will be available for sold. Meanwhile, the 200 unit will go to ending inventory. And the last purchase, 600 units will go to ending inventory. So cost of merchandise available for sale, the total is 45,180,000. Meanwhile, the cost of merchandise sold is 26,720, and we get ending inventory of 18,460. Yeah, just to show you how the cost has been flowed from total purchases or the total inventory that we have. It goes to the total of merchandise available for sale, and then it's split into some units are being sold, meanwhile some units are being left in the company as the ending inventory. Yeah? Okay, for weighted average cost method under periodic system, we use the formula of weighted average units cost, total cost of units available for sale. Yeah, so we take the whole total inventory of units available for sale, and we divide with the number of units available for sale. Yeah? So the total cost of merchandise available for sale for January is 45,180,000, and we divide the total units available for sale, which is 2,100 units. Yeah? So we get 21,510 per unit. Yeah. So unlike perpetual, where you calculate the weighted average cost every time there is a purchase, in periodic, we already identified by physical count that the ending inventory is 800 units. Yeah. So what do we do under weighted average cost? We calculate the weighted unit cost and then we multiply with that 800 units. Yeah. That's why we get the ending inventory of 17,208,000. Yeah. And by using the formula, we can get the cost of merchandise sold. The cost of merchandise sold can also be done by multiplying the cost per unit here, the average cost per unit, multiply the number of units being sold. The unit being sold here is 1,000 plus 300 units. Okay, the use of FIFO or weighted average cost or other inventory cost flow method will result or will affect differently on the amount of cost of merchandise sold, the gross profit, the net income, and the ending balance of merchandise inventory. The first three items you can identify it in the income statement, whereby the last item is disclosed on the statement financial position. So the principle is any inventory cost flow method is used, it will give us a different amount on these four items. Yeah? I think I showed you on the board also. Because let's say in this example, when we use FIFO, our cost of merchandise sold is 26,720. Yeah? So it will give us this gross profit and the ending balance of inventory of this amount, 18 million something. Yeah. But when we use weighted average cost, the cost of merchandise sold, it looks slightly slower because it averaged out all the unit cost. Yeah. Meanwhile, the FIFO, we assume the cost of merchandise sold will only be from the first purchases. Yeah? This one will be the average of all purchases of the merchandise inventory. Yeah? So it will give a different gross profit as well as the ending balance of the inventory. Yeah? So if we use LIFO also, it will give another amount of cost of merchandise sold, the gross profit as well as the ending inventory. Yeah? So in the time of increasing cost, where we assume that the inventory cost keeps on increasing throughout the time, how the different method of inventory cost flow will affect these four items is, so the cost of merchandise sold, the highest amount of cost of merchandise sold will come from the weighted average cost. Yeah? Meanwhile, under FIFO, it will be lower. Yeah? Whereby the gross profit, FIFO will give us a higher gross profit. Yeah? Because it gives us a low cost of merchandise. So that's why a higher gross profit. Yeah? You can try to calculate in the real income statement. Yeah? Let's say under FIFO, let's say under weighted average cost. Yeah? If you have increasing cost of inventory, if our cost of merchandise sold is low, then it will give us a higher gross profit. Yeah? Here under FIFO. Of course, if a higher gross profit, then a higher net income. Yeah? Because the cost of merchandise sold was low under FIFO, then we give a higher amount of ending merchandise inventory because this is the period of increasing cost. Yeah? So FIFO, we assume that the ending merchandise inventory will come from the last purchases or the most recent purchases. So during the increasing cost period, so the last purchases of course will be having the highest inventory cost, we assume. Yeah? That's why the ending merchandise inventory under FIFO is higher compared to weighted average. Yeah? But if throughout the period, the merchandise inventory cost keeps on decreasing, the opposite, so the cost of merchandise sold will be higher under weighted average. Yeah? So when the cost of merchandise sold is higher, the gross profit will be the gross profit during the decreasing cost, the gross profit under weighted average will also be higher, yeah? And the net income will be higher, but the ending inventory also will be higher under the weighted average. Yeah? I want you to try on the real assumption. Yeah? You do the the number calculation. Yeah? You just try to identify the exercise which has a decreasing cost period. Yeah? You see how it's different for weighted average as well as FIFO. Okay. Now about reporting the merchandise inventory on the financial statement. So normally we use whatever the cost of the purchases, right, to report the cost of inventory on the financial statement. Yeah? But there is a situation where other than the cost is being used to value the inventory. Yeah? In the case of when the inventory cannot be sold under normal prices, yeah, due to the damage to the inventory, yeah, or the inventory has been obsolete. Yeah? Obsolete means it's outdated already. Yeah. Let's say our phone suddenly, okay, the company, let's say this Samsung, it sells this type of smartphone, but suddenly this phone, the value becomes very low, yeah, from its normal value, because maybe the customer identify imperfection, yeah, something is not perfect with this phone, yeah. So there is a disappointment, yeah. People are not happy with the product, so that's why the demand for this product becomes very low, yeah? And we cannot sell that product at the normal price anymore. Yeah? So that in that situation, the company cannot report the cost of that inventory at its normal cost. Yeah? So in that kind of situation, the company has to use the lower of cost or market method, yeah? Or LCM, yeah, to value the inventory. Yeah? So the market, in this method, we compare the cost versus the market value. Yeah? The market value is basically the net realizable value of the merchandise. Yeah? The net realizable value, we calculate it by taking the estimated selling price minus any cost that needs to be incurred to sell that product. Yeah. That estimated cost of disposal can include the selling expenses or such as special advertising or sales commission. Or also, if there is any additional cost that we need to repackage the product, yeah, or to a little bit improve the products, that cost will be part of the direct cost of disposal. Yeah? So, for example, the original cost of the product is 1 million, and then we estimate that the selling price will be 800,000. And then the company has to incur additional selling expenses of 150,000. Yeah? So to calculate market value or net realizable value, we take the estimated selling price, we minus the estimated cost to sell or selling expenses, then we get the net realizable value of 650,000. Yeah? So following the law of cost or market value, just now the LCM, we need to compare whether the cost is lower or the market value is lower. Yeah? Whatever the lower value, then we'll take that one as a new cost for the inventory. Yeah? So in this case, the market value of 650,000 is lower than the cost. So we take 650,000 as a new cost for the inventory. Yeah. So in the double entry, we need to record this loss, the difference between 1,000 and 650,000. Yeah? So we need to debit the loss on revaluation of inventory, and we credit the merchandise inventory, yeah, if it is under perpetual inventory system. Yeah. If it is under periodic, then we credit the purchases, yeah, to make to record the decreasing value of the inventory. Yeah? Okay, that LCM method, the company can use it for each item in the inventory or major category of inventory. Let's say the company has so many types of inventory like supermarket, then they can classify it under certain category. Yeah? Let's say food items, maybe beverage items. Yeah? So they can make it lump sum. Yeah? Maybe it's impossible to identify for each item, then they can make it into certain category. Or the company can do that method for the total inventory as a whole. Yeah? So the ending balance of merchandise inventory is reported on the current asset section of the statement of financial position. Yeah? In the notes to the financial statement, the company has to disclose which inventory cost flow assumption that it used, whether FIFO or weighted average. Remember, LIFO is not allowed in major financial accounting standards. Yeah? And then the company also has to disclose which method that they use to value the inventory. Yeah? Okay, this is the example of statement of financial position. Yeah? And if there is an error in us recording the inventory, this is how it will affect on the cost of merchandise sold and the gross profit and the net income. Yeah? Let's say if the beginning inventory is understated, yeah, we're supposed to record 5 million, we record it, let's say 4 million, then the cost of merchandise sold will be also understated. Yeah? Because of cost of goods sold being understated, the gross profit will be higher. Yeah? Yeah? When the cost of goods sold is lower, then the gross profit is higher. and the net income also will be higher. Yeah, this one you can try. Yeah, you can try in the illustration how the inventory error will contribute to the effect on other items like cost of merchandise sold, gross profit, and net income. Yeah, yeah. See this illustration. You compare the correct and the incorrect one. Yeah. In this example, let's say the incorrect one is on the ending inventory. Yeah? The incorrect is understated or lower. Yeah? If the ending inventory is understated or lower, yeah, so the cost of merchandise sold will be higher. Yeah? So that's why it will be the gross profit will be lower because the cost of merchandise sold is higher. Yeah? Try to understand how it affects individually on each item on the financial statement as well as the ending balance of inventory in uh, the statement of financial position. Yeah? Okay, I won't go through on the financial analysis and interpretation. As I mentioned to you, we will cover it in detail during the financial statement analysis. Okay, that's all for the inventory. I hope you read the topic and do more exercises. Thank you. Assalamualaikum.